Chapter 12, Geopolitics. Section 3, Sanctions. Sanctions are economic pressure tools used instead of military force. They can be aimed at a country, a company, a whole sector, or even specific individuals. And for investors, the big issue is how fast they can change whether an asset can still be owned, traded, funded, or settled at all. Not all sanctions work the same way, but they usually cut off access to something important. Trade sanctions limit imports or exports, financial sanctions freeze assets or block transactions, and sectoral measures can restrict entire industries or choke off funding, banking, and technology. At the core, sanctions work by restricting access. If dollar funding gets harder, payment channels narrow, shipping or insurance disappears, and foreign capital pulls back, costs rise quickly and the target has far less room to adapt. That is why markets often react so sharply. Sanctions can feel like an overnight regime change for investors, because the question shifts from what an asset is worth to whether it can still be held, financed, settled, or sold, and that can send prices down while volatility and liquidity stress surge. The effects rarely stop with the original target. Suppliers, customers, lenders, transport providers, and even firms in other countries can be dragged in, while some non-sanctioned competitors may actually gain share as disrupted links break apart. In practice, the process tends to unfold in a sequence. Authorities announce the targets and rules, banks and brokers begin screening exposure, market access starts tightening through trading and settlement restrictions, and then currencies, bonds, and equities reprice very quickly. For financial institutions, compliance is immediate, not gradual. They have to screen clients and transactions, block prohibited payments, freeze affected assets, and reassess settlement and counterparty exposure, because getting it wrong can create legal, financial, and reputational damage. Secondary sanctions expand the risk beyond the named target. A third country firm can face penalties simply for continuing to do business with a sanctioned party, even through a supplier, bank, customer, or intermediary, which means indirect exposure can matter just as much as direct exposure. Russia in 2022 is a clear example of how fast all of this can hit markets. After the invasion of Ukraine, Allied sanctions froze central bank reserves, cut major banks off from key payment channels, the ruble dropped roughly 30% in 2 days, and many investors found they could not exit positions when they wanted to. For investors, the lesson is to think beyond the initial headline target. Sanctions can move commodities, ripple through regional currencies, create winners and losers across industries, and turn liquidity risk into the deciding factor, because sometimes the real danger is not just a lower price, but losing the ability to transact at all.